Welcome everyone to the Mizuho Market Mindset for Q2. Pleased to have with us Phil Tamplin, you've joined us in the past, who oversees our high yield business, and Andrew Simon, who oversees our corporate risk solutions business. So look, we got together last time in January and to talk about the market, and it's definitely an understatement to say a lot has changed. We have tariffs, we have company corporate earnings expected to be lighter, a lot of volatility across both markets. And so I wanted to dive right into it and stating the obvious, Liberation Day has really produced that tariff issue front and center and has created a lot of the volatility and uncertainty. And we see that with the issuers as well as market participants when deals have come to market. At the same time, we've seen a treasury that has bounced around fairly materially over the first 4 months of the year, dipping below 4%. And then gapping out to 4 3/4, where you've kind of been in a range around 4.3%. So maybe there's a little bit more steadiness there. And then finally, the FOMC, we have a who, a what, and a when. We haven't moved rates to date, but obviously there's 3 rate cuts baked into the curve. And then lastly, Phil, on your side, and I'll start with you, we've seen a closed market, although we have seen some tea leaves and some transactions come of late. So I'll start with you. How do we think about not only what we've been through, but really the trajectory going forward?
Sure. Look, it's been an interesting month. April 2nd, I think people expected tariffs, but not in the form they came in. It was a very aggressive sell-off. So the high yield index was 150 basis points wider in the space of a week. Loan index was down 2 points. The market effectively shut for 2 to 3 weeks. We saw record outflow. So high yield was just under $10 billion. That's the largest outflow ever. Loans was just under 5. So there was, I'm not going to use the word panic, but there was definitely risk off. Thankfully, the administration has softened the tone on some of those tariffs and the market's reacted very favorably to it. We've been able to watch the market reopen as you would expect it to. So first of all, IG issuers came to market, then high yield, then term loan B, and then we've seen European issuers as well. So I'd say the reopening has been what you would like to see, which is positive. And of those index sell-offs, you've recovered about 50%. So we're still not back to where we were, but we're definitely in a better position.
I think it was very helpful that from a policy perspective, we found an off-ramp from global tariffs. But there has been some carnage in there. We have a couple of hung deals that were pulled from the market. The banks are holding some of that paper. How do you think about private credit potentially being an off-ramp for some of those hung transactions? And when do those come back to the market to really have a free-flowing market?
Yeah, so there's been a lot of press about the hung deals. Look, they hit an air pocket. Many of those deals, whether it was ABCTI or Patterson, were in market as those tariffs were announced. So it's unsurprising that people couldn't find a clearing level. So again, as we see that recovery, they will come back to market as certainty improves. Look, I think on the hung deal front, the street is significantly less exposed than it was in 2022. That's the positive. The second thing, many of the bridges are now in the form of 364-day commitments that don't have a cap. So that is helpful. And the private credit bids is now back in favor. So you've seen some of these very large deals, whether it was at underwriting or afterwards, where the private credit guys will help clear that. So I actually think it's a very helpful relationship. Sometimes the syndicated market will be stronger, and other times the private credit bid will be helpful. People talk about competition. I think it's healthy, and I think those two will always be in balance, and just depends where the pendulum sits.
I would agree with that. I think the private credit market almost is a shock absorber for the syndicated loan market when it hits those especially rough time periods. On your side, I alluded to this at the beginning, it's usually the what and when. But to some degree, in the news cycle the last couple of days, it's been the who as well. So why don't you spend a few minutes on the Fed, rate cuts, outlook, and maybe what clients are doing?
Yeah, sure. I mean, listen, as we sit here today, the market's got some pretty aggressive expectations for easing. It's about 125 basis points over the next, call it 12 to 15 months. And remember, that's on top of the 100 basis points that we've gotten already, right? So that's pretty significant cuts from the Fed. Is this the market backdrop for that, right? Keep in mind that we're a fairly healthy economy going into this recent bout of volatility. The economy is actually doing pretty well, right? The labor market's really strong. Inflation has been a little bit sticky. Keep in mind that we haven't had that asset liability mismatch that typically causes a credit crunch. So is another 125 basis points of cuts here realistic for the market environment that we've got. Keep in mind also we have the Trump tax cuts that might come later this year. That's very stimulative from that perspective. So we think the market's got it wrong. We're actually forecasting no additional cuts from the Fed, which is a very different outlook relative to the street and relative to our peers.
We're seeing that with the early indications of reported earnings for Q1. So that's interesting that we're taking a little bit of a contrarian view to the market. So Phil, we did see some tea leaves over the last couple of weeks, and I think the deal that we led for Venture Global really reopened the high yield market. Spend a minute on how investors are viewing new issue, and alongside that, opportunistic or the commitment pipeline that ultimately will have to come to market.
So we obviously had the privilege of reopening the market with Venture Global. They launched $1.5 billion and took $2.5 billion. I think before we launched that, the conversations around cash management, you had the optimistic portfolio manager that had higher cash balances because they were looking forward to primary, and that's a good entry point. You had the pessimistic PMs who had higher cash balances because they were concerned about more outflows. Thankfully, the market has gone in the optimistic direction. Venture was a huge success. The book was over 3.5 times oversubscribed. The deal was upsized. And has traded well on the break. Immediately after that transaction, you saw Accelerate come to market, you saw Jane Street, and then just this week you saw Beacon QXO. That transaction was both secured bonds and Term Loan B. So that's the first Term Loan B to price post-market close. Both of those were launched at $2 billion and upsized to $2.25 billion. And I think you're going to see more that will come from that. So again, this to me is just the natural reopening cycle I talked about. It's like IG, then high yield, then loans, then Europe. And we've started to see that. I think in terms of pipeline, obviously the hung deals that we talked about, they could come back to market. There's a long list of other underwritten deals that haven't closed yet. Those will come. I think we're probably another 50 basis points of tightening before you start to see many of the refinancings. Because yes, we found stability, but the execution levels are still far less attractive than they were just 4 weeks ago. So I think it'll be where they have capital needs, either M&A or capex build-outs. Those will be the first back to market, and then we'll get back into the usual.
In a nutshell, you're seeing a strong bid for the right deals that are structured appropriately and pricing that fits investors.
I mean, today they've been higher quality or higher rated. They've been known assets, so people know how they should perform in this tariff environment. I think the longer we stay in this type of environment, then risk appetite will improve and we can move down the credit spectrum.
Yeah, and there's a pretty wide net of what clients are doing. We see some that are looking at new issue. We also see clients are doing debt buybacks and as well as equity buybacks. So I guess I'll turn my attention back to you again. What type of thing are issuers thinking about, and what type of interest rate swaps are you working with clients on?
Yeah, I would say the focus is de-risking, right? If you think about the volatility that we've had over the past couple of weeks, we've had intraday swings in the Treasury market of 25 to 30 basis points. As an issuer, you're worried about that, right? It used to be 2 to 5, 20 to 30 is pretty significant. So people look at their 25 and 26 refinancing needs and try to take that risk off the table by doing a rate lock. For our floating rate borrowers, we've been very active in swapping their floating rate term loans to fixed. In today's yield curve, that produces about 80 basis points of savings. So you're de-risking and providing interest cost savings. So it's been a very attractive transaction in the current market. And I'd be remiss not to talk about the FX markets. FX markets have been extremely volatile. The dollar has depreciated pretty significantly over the past couple of weeks, given kind of the change in tariff policy of investors have left the dollar market and into other safe havens. So we've seen a pretty strong uptick in client activity in net investment hedging. So locking in the higher value of their foreign assets and also providing some significant interest cost reduction by moving to those lower yielding currencies. So where is that? That's euro, that's Japanese yen, Swiss franc, and CNH. And then lastly, on the kind of tariff front, geopolitical, cross-border M&A and the interest rate hedging and foreign exchange hedging related to that, deal contingent structures continue to be very popular, especially in this politically charged environment.
Great. Thank you, everyone, for joining us. It's obviously going to continue to be a rather volatile market, but we do see ways that issuers can access the market as well as use hedging solutions to navigate these interesting times.